basis points odd. We have some reactions that are coming in there. Rajesh joins us. Hi Rajesh, thanks so much for joining in. You've had some time to look at these numbers. Your initial take on it?
Yeah, hi, good afternoon. Numbers are obviously slightly disappointing from what we were expecting, though top line seems to be, fairly in line. That there is no miss at the top line level, but I see other expenses in this quarter is higher. And as you said that because of this maintenance expense which they would have mentioned, I believe that could be one of the reasons.
Okay.
And obviously more details on the volume number would be required before we see operationally how have the realization and cost metrics are moved.
Okay.
Nonetheless, the margins are obviously sequential basis. If I see, the margins have come off from 16.5% to 16%. So that is slightly negative in my view.
Right.
Given that the operating leverage should have played out, cost also has more or less stabilized in this quarter. Margins sequentially should have improved in my view.
Okay, all right. Rajesh, hold on to that thought. We have Mayuresh as well that joins in. Mayuresh, you have had a look at the numbers. Give us your initial take.
No, so Nigel, as you were pointing out, I think the volumes are, as you are mentioning, they are a good set of numbers from a volume perspective. What has probably happened in terms of stickiness of realizations is something that would have got played out on the top line. The margin is a miss, but as you're saying, if there is a overall on one of the plants, I think that might have been one of the factors going forward. So how do these cost synergies start building into their balance sheet over the next few quarters? Because freight costs definitely are coming down. You're probably also seeing the other elements of incremental cost burden coming down. And what probably happens in terms of the sweating of assets, I think that is extremely important. The other point that you're probably mentioning, Nigel, I think is going to be very critical as well. I think how the trade segment has performed, the white cement realizations, and third, I think the production cost differential between JPSS and Ultratech. Last quarter, I think it was around 35 rupees a ton, which excluded the statutory costs, including around 70 rupees per ton of the acquired mines. What happens on that front, whether they are able to marginalize or minimize that cost, is going to be extremely critical. And again, I think what probably happens in terms of the new acquisitions and the volume growth that they can drive in terms of asset sweating going forward.
Okay, all right. Just hold on to that, gentlemen. I'll just tell my ticker team, actually, the sales volumes number actually should be 18 million tons. You need to compare it on a like-to-like basis. The total sales volumes, the poll for that was 17.55 million tons approximately. So we'll just correct that number. The sales volumes actually are a little better than what we're working with. It's at around 18 million tons. That's the number. Because in the standalone entity, you're referring to the total domestic sales plus clinker plus the exports. So it's actually 18 million tons. That compares with our poll of around 17.5 million tons. That's a little better actually, and that's the reason why there's a bit of a beat on the top line itself. So let's get that number up for you. In terms of domestic sales, that's up by close to around 14%, and in terms of exports, that's up by around 13%. That's telling you that the total volumes have grown by around 14% in comparison to around 10.5 to around 11% that we are working with. Rajesh, the volume numbers are in. Your comment on it, 18 million tons is the total volumes. Domestic is coming at around 17.1 million tons.
Yes, so I see on a blended volume 18 million tons. Sequentially, there is a 15% volume growth. Realization, however, on a totality basis is down 2% sequentially.
Yes.
Though we were modeling in 1% sequential dip, 2% is slightly higher. On the input cost front, I generally see raw material and power together. That sequentially is largely flattish, which is a healthy sign. Now, the only thing is that sequentially there is no moderation in other expenses. Ideally, with volume growth, that should have come down. In terms of freight cost, there is a marginal moderation, which is good.
Okay.
So I believe the other expenses, there was some room for, that, if that was a large one-off which the company, which they may clarify in the call. Because one more thing is that they have been talking that the JPS numbers should start to improve in subsequent quarters. And second, their management has also been guiding that they will improve the trade sales.
Correct.
Which earlier was 75%.
That's come down to
2 years
60.
back. Yes, 65 was in last quarter, and they have indicated that they will go back to 70%.
Okay.
So trade sales improvement will boost margins. So those details are awaited.
Okay. All right. Thanks so much, Rajesh, as well as Mayuresh, for joining in and giving us those details. So, well, that's the verdict, Prashant, on Ultratech Cement. Volumes are a little bit better than we're working with. Realizations appear there's a bit of a miss, and they had some extra overhauling costs on one of their central India's plants, and that could explain why the margin compression is a little extra than what we were working with. It's at around 100 basis points. We were working with margin compression of around 40 basis points. So a mixed set of numbers coming in there, but not as bad as the whisper number actually.
Okay, Nigel, thanks very much for that. That is Ultratech for you. So a couple of numbers in quick succession. The big other one is going to be Yes Bank, and that should be out in the next 30-40 minutes or so. I'm going to wrap up this edition of Mid-Cap Radar. We are coming back in just a bit and take all of the action forward. And of course, I'm going to quick preview on Yes Bank, maybe the last one before the numbers actually hit the tape. Back in two.